And I work with the Great Lakes Intertribal Food Coalition and the Menominee Tribes Department of Agriculture and Food Systems. And I'm gonna help facilitate the presentation this morning. So this is I guess this is our third tribal food producer info session, right? Yeah. We'll get started. I'm going to why don't you go to the next slide? We started recording. We're going to talk this morning about a few things, but primarily we're going to talk about tax preparation and tax resources. Seeing as it's just March, we thought now is a good time to start thinking about what kind of information we need to keep track of, what kind of receipts we want to save, and get ourselves ready for the end of this calendar year to get our taxes done. So Dale's going to help us do that. And then, like Jamie said, if you have particular questions, please put them in the chat and we'll do our best to keep track of them. And we'll have some question and answer. And then we'll do some brief introductions. Again, I'm Jen with Menominee Department of Ag and Food Systems. I'm an Oneida Nation member. I live on the Oneida Reservation and I operate a small farm there. Dan, you want to introduce yourself?
Yeah, thank you. I'm Dan Cornelius. I'm also a member of the Oneida Nation. I work closely with Great Lakes Intertribal Food Coalition, and I also run a small farm.
And Mark?
Second here. Poso, everybody. My name's Mark Greeno, part of the Menominee tribe, and I am the, Intertribal Food Business Development Coordinator for Menominee Tribe's Department of Agriculture and Food Systems. I'm also a hemp farmer, and I grow peppers as well. But great to be on the call today. Look forward to learning more from you all and also just seeing how we can help you guys out. So thanks so much for being on the call today, and I kick it back to everybody else.
Julie.
Hello, everybody, and welcome. And yes, this is our third tribal producer information session, and my name is Julie Jesmer, and I am the Business Builder Grant Manager for the Great Lakes Midwest Regional Food Business Center, and I will pass it to Jamie.
Hi all, glad to see you here. I'm Jamie Rarig. I'm at the Michigan State University Center for Regional Food Systems and the Product Center, helping with some back of the room help today. And I'll pass it to John.
Hello, everyone. John McCarthy. I am working with Julie on the Business Builder Grants and the Grant Support Specialist.
Great. So we're gonna, as I kind of alluded to already, do three things today. Some resource sharing to hopefully help all of you get prepared for the end of the year. We're gonna do some co-learning, and many of you know I'm a small scale farmer and I'm learning this stuff just right in time in order to talk to you about it. So I am not that far ahead of some of you and I'm behind a lot of you. So don't think that I'm an expert. I'm learning as we go as well. So if anyone else has advice or tips, please share them so that we can all do our best here. Getting ready for tax season. And then of course we want to connect and we want everyone to be able to reach out to both us, the TA folks, and each other to share, knowledge and tricks of the trade. I think a lot of folks on this call are tribal elder food box producers. And some of you may not be, but might be interested in that. And so we definitely want to hear from you. If you have particular tribal elder food box program questions, feel free to ask those as well. And I'm going to turn this to Julie, right?
Yes, thank you, Jen. I am just going to give you a brief overview. The Great Lakes Midwest Regional Food Business Center is sponsoring this particular information session today. And so we wanted to give you a brief background on what the regional food business centers are. Next slide, Jamie. The Regional Food Business Centers are 12 centers located across the United States, and this one happens to be the Great Lakes Midwest Center. And we are, you can see in the slide, we cover Wisconsin, Michigan, Illinois, and Indiana. And we are led by the Michigan State University Center for Regional Food Systems. So Jamie, John, and I are part of that program, as well as a couple other people on the call today. We have the network coordinators are our key partners within this program, and you can see all of their logos on here. And part of that is the Menominee Nation, and they are our co-sponsor today. Next slide. And we just wanted to kind of show and give you a little bit of background about what we do. We are sponsored, we coordinate the food and farm businesses within that 4-state region, and we provide assistance as well as capacity building. We are in the middle of building up our assistance program. Soon you will be seeing a form that you can register as a service provider. You need to keep track of our website. These things are slowly being built up. We are going to be doing, in the assistance realm, we are going to be doing matching people who need assistance and with those who can provide that direct technical assistance for small and mid-sized food and farm businesses in the area. And then the other thing that we provide is capacity building through financial assistance. And those are the Business Builder Sub Awards. And those are being organized and set up right now. And they will hopefully be online within the next few months. Next slide. And the assistance is you can get one-on-one support, you can attend a cohort or class. It can be individualized learning, but it can also be specialized services from service providers. So if you need to learn how to do your taxes, like we're talking about today, we can help connect you with somebody who can help you learn how to do that. Next. And then the Business Builder Awards. These are the capacity building grants. And next slide, we are setting up this program right now. This is a cooperative agreement between the United States Department of Agriculture and it's the Agriculture Marketing Services. And so that's why it's connected to food and farm businesses. And our goal is to help food and farm businesses network and connect with each other to expand their market access and their market share. The Business Builder Sub-Award Program, we will have funding available through 2027. And the phase 1 is going to be targeted to farmers, farm collectives, and food harvesters or producers that are located within the federally recognized tribal lands. It is related to post-harvest activities. So anything, again, that can that you can point to that can expand your market access or market share. Keep watching our website at the Great Lakes Midwest Regional Food Business Center to pay attention and watch for the grant announcements when it is opened. And I believe that's it for me. Next slide. Yes, Jamie will start us off with a poll.
I'm gonna discuss the poll a little bit, and then we're gonna ask everyone to answer that. Or answer both questions, but the first one, how would you describe your tax reporting knowledge? This is jumping into the meat and potatoes of the presentation this morning or this afternoon almost. And we're interested in finding out where folks are at, so that we know that we're providing you with the best information and what's most useful to you. So the first question, how would you describe your tax reporting knowledge? I think we can put the poll question up on the screen. So number 1, I know it all. Number 2, I know what I need. Number 3, I could use some help. And number 4, I need lots of help. So if participants could choose one of those options. And then the second question, the reason we're asking this question is because it helps us to understand the scale and size of operations. So, you know, if you're a 50,000 or more annual sales or gross annual sales per year, that's one thing. And if you're 10,000 or less per year, that's another. And so we want to make sure, again, we're providing everyone with information that is going to be useful. So if you could answer that second question as well.
And no one will see your name.
Yep, and no one will
associated with-
see your
yeah.
name. It's totally anonymous. I should have mentioned that. Thank you, Jamie.
Yeah, we were a little slow to get responses, so I thought we might want to say that out loud. Okay, great. Looks like it's slowing down a little bit. I think we can share what we've got so far.
Thank you there. All right, so we have the majority of folks in the, I know what I need and I could use some help. And then it looks like I don't know if I'm seeing the whole thing here.
Maybe I need to make it bigger. We've
You
got
scroll down.
scroll
Yeah,
down.
scroll
Yeah,
down.
I scrolled as much as I could.
So we've got the majority of folks, about 2/3 of you who are 10,000 or less gross annual sales per year. And then the other third of you are more than 50,000. That seems to me that that's going to be really useful information for us. And then at this point, now that we know that, we're going to jump into Dale Grant's presentation. And Dale, I'll let you introduce yourself and take it away.
Thank you. Hello, my name is Dale Grant. I'm a CPA. My firm is Ashton Business Consulting. I've been a CPA for, say, about 15 years now, and I've been in private practice for about 8 years. I specialize in working with individuals, businesses, and nonprofits. We provide accounting, bookkeeping, and tax and advisory services to businesses in and around the Detroit metro region. And so today we're going to primarily speak about taxes. Today we'll primarily speak about taxes. I see that some people feel like, you know, they could use some help, and then some other ones feel pretty secure in it. We're going to start as sort of a top-down level, just sort of explaining what tax returns you can expect to be preparing. I'll provide some examples, and we'll talk about the different types of tax returns. And then we'll also talk about some of the information that's critical to being able to prepare those returns. And so even though we've got quite a few people here, this is an open forum. So if you have a question or if you feel like maybe you'd like some more information than what I provided, feel free to jump in the presentation, either in the chat group. I'm sure that one of the moderators here will be monitoring that chat group, or feel free to just turn on your mic and say, hey, I've got a question. I don't mind. And it kind of add some energy when we've got some other people talking in the presentation as well. And so with that, let's go ahead and get started. Let's just kind of talk about, first of all, taxes at a high level. As you're thinking about your tax returns, first off, your entity type is going to drive your what type of tax return that you file, right? So that's dependent upon how you set yourself up in business. If you are a single member, sole proprietor, then you're going to file that Schedule C with your 1040. I'm sorry, excuse me. You're going to file the Schedule F with your 1040. If you have set yourself up as a partnership, you're going to be required to file the 1065 tax return and then file your 1040. And if you have set yourself up as an S Corp, you're going to be required to file the 1120S tax return and, of course, your 1040. And then finally, there's the C Corp corporation, which is an 1120 with your, and of course, individually, your 1040. So if you're unsure of your entity type, you can always find your EIN information that you originally received, and that indicates what you said at the beginning when you set up your business. And then you can always reach out to the IRS. The IRS has a great number of resources on their website, and it's actually a lot easier to use than you may think. So if you have any lingering tax questions or you need to obtain tax information, you can always Google irs.gov. One way is irs.gov and my account. That will provide you with a link. And always when you go to the IRS, you want to go to a .gov website, but the my account will help you find your personal account information. Even if you have not set up an IRS account previously, once you go to set up that account through that .gov website, it's going to require that you add in or that you include your social security number. And based upon your social security number, your information will pull up. So even if you haven't set up an account in the past, once you put in that social security number, your information will update. You can also find information with regards to your business. So let's say, for instance, once again, you're that partnership or an S Corp or a C Corp, you can Google irs.gov business account. And the same thing is true, where you can log into the IRS account, you can set it up, and once you put in the EIN for your business, it's immediately going to pull up your information with regards to your return. And so, give me 1 second. I'm going to pull up my first sample return. We can go through it together.
And while Dale's doing that, I'll just say what I mentioned in the chat. We will share the links that Dale's talking about or that the team presenting today is talking about here in the chat, but we'll also send you a follow-up resource with a link to this recording that you can have. It'll come probably a week-ish or so, maybe 2 weeks, depending on our schedules. That'll come out afterwards, and we'll post it to our website.
Thank you. So the first thing that I like to explain about taxes to business owners and to make sure that you understand that is for your 3 entity types: S Corp, partnership, and sole proprietor. Now notice I've said sole proprietor and not LLC. LLC is what's considered a state designation. The federal government doesn't really recognize LLC. They see you as a sole proprietor. That's the term that they're going to use as it pertains to your taxes. But those 3 entity types are what's known as flow-through organization. What that means to you as a business owner is that your business does not actually pay taxes. Instead, the income earned by your business or the loss incurred by your business flows through to your personal return. So even in the instance, and we'll see that where the partnership return and the S Corp return has its own tax return, there's never going to be a tax liability associated directly with that return. Rather, that income will end up on your personal return, and the income from that business will be, or rather, the tax liability for that business will be based off of the tax bracket that you are in. So for instance, let's say you're one of those farmers, you're starting off fresh this year or last year, and you didn't have much income. Maybe you only had, $15,000 net income, but you also were employed throughout the year and you made $150,000. When you go and prepare your return, that income that you earned from your job, right here, this W-2 income, that $150,000, is going to appear in box one. And then as we go down, further down, your income earned from your business will appear in these lines down here. And that's going to be added up to your total adjustable gross income. And then you'll be taxed at whatever your tax bracket is for the 150 plus the $15,000, the 165. So you'll probably end up at about a 14 or 20% tax bracket, depending upon different status. But the main part is that the income earned or the loss incurred by the business flows through to your personal returns. The next part that I always like to stress when talking with people about their taxes is that while there are plenty of tax credits available, and they can vary depending upon your situation, there really is no magic bullet to lowering your tax liability. The best way to lower your tax liability is to make sure that you have a strong accounting system where you are reporting all of your revenues and, more importantly, reporting all of your expenses. And so that kind of gets into the discussion of how you do your accounting. A lot of times when I meet with clients and they are in their first couple of years in business, they may not have set up, I'm a proponent of QuickBooks. So that's typically what I'm going to use, but they may not have set up an accounting system. They may not have set up a QuickBooks. Hopefully they've got a business bank account. And likely, what they've done in the past is maybe just taking those bank statements and giving it to a tax preparer and ask them to prepare their taxes for them. And maybe that can work when you don't have a lot of transactions. I won't prepare a return like that. Typically when I get it, I'm going to tell that client, we need to figure out, a way to put this into a profit and loss statement. We have to have a profit and loss statement. My preference is to allow me to set up a QuickBooks account for you to get that profit and loss statement. And we're going to see in just a moment why that profit and loss statement is so important. But I guess the overarching point is that if you do not have an accounting system, you likely will not be recording the correct tax balances. Simply because mathematically it's so easy to get it incorrect. So you definitely want to have, I strongly advise, if you do not have an accounting system, to get an accounting system in place. The other reason for that is that most times when you are going to apply for a business loan or a business grant, that lender or those grantors are going to request 3 years financial statements, 3 years tax return. Now, there are instances in which they might not request all 3 years. Maybe that's because you've only been in business for a year or two. But for those years that you have been in business, they are going to want 3 years financial statements, 3 years tax returns. And of course, to put yourself in the best position, once again, mathematically, you want those numbers to tie. There are sometimes small differences between your financial statements and your tax records, but usually that's reconcilable. But you want those numbers to match up. And that kind of goes back to that point. If you're just handing bank statements to someone and asking them to prepare your taxes, when you hand your bank statements off to someone else and ask them to prepare your financial statements, it's likely those numbers aren't gonna match up. So you definitely want to do that together. So here we have your 1040. Now, if you are a sole proprietor, you're going to report your taxes on your Schedule F, which is specific for farmers. Now, once we get to our Schedule F, it's going to mirror your profit and loss statement, where you've got your revenue up top, your cost of goods sold, and then your operating expenses. So your profit and loss statement, once again, is so key to making sure that you recorded all of your revenue, all of your expenses. As you all know, If you are any type of small business, you have likely received a 1099. The IRS also receives that 1099. So one of the things that I want to see, the rule is, as a business owner, you are simply required to report all the income you receive, whether or not it's been reported to the IRS or not. Typically, I don't need a 1099 to prepare the return because I'm using the profit and loss statement, but I want to see the 1099s when I prepare the returns because I know for a fact that we cannot show less revenue than what is on the 1099. So you always want to be cognizant of that because if you do show less revenue on your tax return here, line 1A, then all the added up 1099s, the IRS is going to send you a very nice letter explaining that you clearly made a mistake and that you underreported your income, and they're going to request that you do it again, or they'll do it themselves, which you may owe even more money. But we need to make sure we have our total revenue, and then we want to make sure we have our cost of goods sold. And I'm not going to go through all these specifics, but cost of goods sold is very important. It's a great measuring tool for comparing yourself to other farms, especially like farms, if it's geographically alike, or if you have some of the same products, it helps determine if your costs are in line with other costs, though you may not always have that information. But your cost of goods sold is simply what it costs you to provide your product or service. That's always going to be one of your biggest write-offs. It's what it costs you to provide your product or service. So in this case, it might be livestock that you are purchasing. It could be feed for the livestock. It could be seeds for your farm. It could be any expenses that are incurred specifically for providing your product or service. That's going to go up here in our cost of goods sold. And down here are all our operating expenses that we incur throughout the year. And this is one of those reasons why you need to have that, why you need to have a profit and loss statement. Because a lot of times, as business owners, we'll remember the big numbers. Oh, I had to buy cattle this year, and it was quite expensive to purchase that cattle. I remember it was $20,000 that I purchased, this product here. Versus, you might not remember that, you went to Office Depot and bought a pack of paper for $15. And while $15 in and of itself isn't a lot, once you do that throughout the year, you find out that you really had office expenses to the tune of about $1,500 or $2,000. So those very important that you maintain that profit and loss system, that is profit and loss statement, that is reconciled to your bank statements, and that you have that information available for your tax preparer so that you're receiving all of your expenses. But here on our Schedule F, which is if anybody has been a small business owner in a different arena, it's the exact same thing, or it's very similar to your Schedule C. It's simply for farming expenses. But here you're going to have your operating expenses. Now, as you see on this sample, the IRS just gives us, I don't know, it looks like here maybe 15 different categories. We are not beholden to just these 15 categories when filing our taxes. If we have other expense lines, it's going to go into our other expenses. So one of the common things that I see with people when they do profit and loss statements on their own is that they might be too specific with their expenses. And what I mean by that is I might see something that says something to the effect of, here's my profit and loss statement. And, I had $1,000 in expenses for Adobe software. And then I had another $1,500 in expenses for ink and paper. Well, I'm just going to add those two numbers together, the Adobe software and the $1,500 for the ink and paper, and I'm going to put that into office expenses. So when you're thinking about your profit and loss statement, you do want to combine like expenses, but you do have to have a degree of separation so that you can analyze the information in a reasonable manner. So one, it's easier to have a template, but two, it's an art and a science to it. But essentially, in this part 2 section, this is going to be your operating expenses. Now, if we notice up here, we've got car and truck expenses. When doing our taxes, typically what I find, now there's going to be a caveat here, I'm going to give that to you guys. Typically, what I find with car and truck expenses are that mileage will get you a better deduction than writing off the actual expenses. So let's say, for instance, you've got car and truck expenses, and you got a brand new truck, and you excuse me, and you just write off the gas that you purchased, and maybe you purchased $3,000 worth of gas, but you drove 10,000 miles. The IRS is going to give you 65 cents a mile, which is going to be about $6,500. So in that instance, it's going to be better to take the mileage. You can take the higher of the two, mileage or the actual expenses. Now, the actual expenses actually include gas that you purchased, any repairs or maintenance that you've had to your vehicle. You can also write off your auto insurance. It's going to be a portion of that. All of those can be included in your actual expenses. But typically, we find that mileage gets you a better write-off. Now, I'm going to say the caveat to this is that I would typically use this one, car and truck, for my vehicle that I'm using for operating the business. So this might be either my personal vehicle because I'm using my personal vehicle for the business, or maybe I've got, a pickup truck that I solely use for the business. I'm going to separate that out from, let's say, for instance, I've got a tractor. I'm going to put that on a different line item. The tractor is solely for business. Because I may be taking mileage for my vehicle. The cost for my tractor, that's more of farming equipment. And that's how I'm going to dedicate that expense. So with these expenses and with being farmers, you want to give some thought to what is truly the use of that expense. In accounting and in tax, we're given a framework with how to think things. Because as we know in business, it's not always an A and B answer. Once again, I may have, as an accountant, I may have a truck that I use that I write off in my business. The truck that you use and you write off in your business as a farmer may have a distinctly different use in the business. Whereas mine is simply mileage because I'm going to go see clients. Yours may be, well, I'm using this 100% in the business, to deliver goods, to haul things. It's going to be a different rule with regards to writing that off, simply because part of mileage is limiting, is how much of that vehicle is used for business versus personal. So just things to keep in mind, especially things to keep in mind, because car and truck expenses are going to be a little bit different than what you have on your profit and loss statement. Let's see here. As we come down through another good one is going to be mortgage interest. Once again, for those of you who have received a farm loan for your property, maybe you have a mortgage on that, you can write off that mortgage interest. You want to be sure that you're claiming that, not the principal, but the interest. You want to be sure that you have that on that as well. And then we also should have business use of home. I don't see that here, but typically we can take business use of home. Farmers would be no different. Business use of home is going to be a percentage of, well, what it is that if you have a dedicated space in your home from which you operate your business. So let's say, for instance, you turned a bedroom into an office. What the IRS does is they take the percentage of the size of that bedroom as compared to your entire home. So let's say, for instance, it's a 10 by 10 bedroom at 100 square feet, and you live in 1,000 square foot office. That's 10%. They're going to take 10% of those allowable expenses. So it will be your home mortgage interest, repairs and maintenance made to the home, insurance for the home, and utilities. We'll add all those up, and 10% will be your deduction. So that is another deduction that goes on top of the deductions that you wouldn't see in the profit and loss statement. So typically, the car and truck expenses are one of those deductions because of the mileage factor that we don't see on the accounting profit and loss statement. And the business use of home deduction is another deduction that we only see for tax purposes. but it can offer a pretty good deduction. But as we talked about before, your business, once again, is what's known as that flow-through entity. And so in this example, we had $75,000 in total revenue for the year. But after we took in consideration our cost of goods sold, which took us down to $43,000 gross profit, then we subtracted all of our operating expenses that we had, we were left with a net income of $12,300. If we go back to our 1040, we see our 12,300 on line 8. And it actually came from a different part, schedule 1, which was our farm income, and reports us back to schedule F, and ends up as our total income. So if this was our only income for the year, here it is reported on the front page of our 1040. If once again, and if you were to go get that loan or to go get a grant and someone were to ask for your business tax return, in your case, I would just give them the 1040 with the Schedule F, but the Schedule F is what constitutes your tax return. And as you can see, it's got that profit and loss name there. Does anybody have any questions with regards to this here? Here, we go back and stop down for just a moment. The system logged me out for just a second. So now let's look at the 1065 tax return. And as I'm pulling that up, keep in mind, if anyone here on this call is a partnership or an S corp, your taxes are due, your tax return for the business is due March 15th. So if you need to file an extension, now would be the time to do so. Take a break real quick. I'm just looking at the chat to see if there are any questions here.
I don't see any questions right now, Dale. Curious to understand the difference between a 1065 and the Schedule F, though.
So here, if you are a partnership, as it pulls it up, you're going to file your 1065 tax return. Just looks a little bit different than that Schedule F, but in the same instance, we're going to use our profit and loss statement, and we're going to use that to complete the front page of our 1065. And then the same rules apply when we've got our revenue, our top line revenue here, our cost of goods sold, which leads us down to our gross profit. We would have had operating expenses here for comparative purposes. I didn't add that in there, but that brings us down to our total net income in this instance of $62,500. On this form here, for each person, you're going to get a sample K1. So this is just my sample business owner. I just named them sample. But each business owner would receive a K1. And in this instance, they're 50-50 partners. And so here we've got their ordinary business income at $31,250 for their income. And also, had this been an actual return, there would have been, let's see here, self-employment earnings would have been reported here. It would have also been $31,250 here. You would then use your K1 from your 1065 to report on your 1040. This information actually goes into the Schedule E, Part 2 of your 1040. And then just like with that 1040, with the Schedule F, once you report that income from your K1 onto your 1040, it's going to appear on that front page of your 1040 on that line 8 as income only to be added to additional income. Now, what is also true is that if you have a loss, that loss can offset other income that you have. So let's say, for instance, this was a loss of $15,000 and you had W-2 income of $100,000. You would have that W-2 income at $100,000 minus the $15,000 that you lost. And now you've only got taxable income, adjustable gross income at $85,000 instead of your previous 100 from your W-2, because your loss from your business was able to offset your income. Keep in mind, the IRS does have what they call hobby loss rules. Essentially, what that means is that as a business, you should not be taking losses for more than 3 out of 5 years. Things happen. Not everybody gets called on it, but kind of keep that in mind. You cannot take continuous losses. Now, here's an important example. With the 1065, we always have the opportunity to take that loss. As we go over to our 1120S, the 1120S behaves and looks very similar to the 1065. It's simply just a different return. But you're going to have the same instance where you're going to have your information on the front page of your returns. I didn't fill it out this time. But you're going to have that same K1, just like you did on the 1065. The only difference, so with the 1120S, you do receive some other differences. As a business owner, when you have the option to be taxed as an S corp or to become an S corp. And once again, if you are an S corp, you would file the 1120S. So why would someone choose to be taxed as an S corp or to become an S corp? The reason is that as a sole proprietor and kind of as a partnership, there's some more rules involved with that, but just to make things simple, in those two entity types, technically you cannot be an employee of the business. So as such, you shouldn't be getting a W-2 from the business. Sometimes that happens, but you really shouldn't be getting a W-2 from the business because you legally cannot be an employee of the business. What that also means is that the income from your business is subject to an additional tax. It's subject to your withholdings tax, which is at your typical tax bracket of whatever it is based upon your income, your situation, 15, 20%, 22%. But you are also subject to self-employment tax of 15%. So just to make it, just for easy numbers, let's say we have a business that makes $100,000 and I'm either a sole proprietor or a partnership. That $100,000 is subject to a 20% withholdings tax because that's the tax bracket I'm in. And that $100,000 is subject to a 15% self-employment tax. And that's simply because of the entity type. Now, I can choose to become an S corp, which is the 1120S, and I am then allowed to be an employee of the business. To be an employee of the business, what that means is that I have to give myself a reasonable compensation. So now I should be receiving a W-2. So let's say the business made $100,000 and I've decided that my reasonable compensation is $60,000. Take a pause real quick. What is reasonable compensation? Reasonable compensation is what you would pay someone else to provide the services in your business. And I understand that as business owners, we're all the hats in the business. So more or less, I would think about it, once again, in my terms, I would think about it like how much would I pay, a senior accountant or an accounting manager, or in your case, you might, how much would I pay, someone to manage my farm? That might be what you use for reasonable compensation. But what's most important about that is that there are tax savings associated with it. Because unlike the first scenario, we still made $100,000. We're still paying 20% tax on withholdings of that $100,000. But now we're only paying self-employment tax, which is essentially Social Security and Medicaid, on the $60,000 of income that we have, instead of 15% on $100,000 of income. So that savings, that $40,000 in difference that we did not pay 15% tax on, is a savings to us. So becoming an S corp does have tax savings advantages associated with it. So once again, your option is to be taxed as an S corp if you want to have that option that we just discussed, or you can become an S corp. When you become an S corp, you have the same tax savings options that we just discussed, but now you also have shares of ownership. And this gets into, transference of ownership. As a partnership or as a sole proprietor, you should have an operating agreement, which is a legal document. And the operating agreement essentially indicates what everyone's ownership level is, how much they've invested, how much they will receive if the business were dissolved. If you wanted to add in another owner, maybe you've got an investor, you would have to amend that operating agreement. And every time thereafter, if you wanted to add another owner to the business, you would always have to amend the operating agreement, and you would need to have all the current owners vote and essentially reach a quorum, which is majority rules, in order to add that new business partner. That is if you're a sole proprietor or a partnership. If you are an S corp with shares, if you want to add a business partner, you simply need to sell them the number of shares equal to the percentage that they'll get. So let's say they wanted to be a 20% business partner. Perfect. I'll sell you 20% of shares. You don't have to amend the operating agreement. You don't have to reach a quorum with the other owners. You simply transfer those shares, and now they're an owner. So for many people, this is a good option after they've been in business for a while, and now they're looking for tax savings. Because once again, you can both lower your tax liability as an S corp, and if you're looking for equity investment, it is very easy to transfer ownership. The caveat, or I guess the con to the pros of the S corp, is that if you are in a period where you are experiencing losses, you may or may not be able to use those losses to offset your other income. So like we talked about before, where we had a business owner that had a W-2 and they're receiving $100,000 in W-2 income, but their farm lost money. Their farm lost $15,000 this year. As a partnership, as a 1040 with Schedule F business owner, the sole proprietor, we would simply net that $15,000 loss against the $100,000, and now that takes their adjustable gross income down to $85,000, which will put them into a better tax position because they get to use the loss. As an S corp, you are subject to certain rules that may prevent you from using that loss. Essentially, if you don't have equity in the business. And we see that at times where people don't have equity in business, primarily because they've taken out loans or some sort of debt to help them get by. And when you do that, it will cause you to go into negative equity in the business. And essentially, writing off your loans as 1120S, you can only write off what you have equal to in equity. So if you don't have any equity, you can't write off that loan. You can hold on to the loss and carry it forward indefinitely and use it in future years when you have built up equity, but you won't be able to use it immediately if you don't have that equity. So that is something to think about with regards to that S corp designation. Also, if at a later date you want to no longer be an S corp, you really have to wait 5 years after electing to be an S corp before you can change that status again. So it's something to think about. But it does have its advantages to being an S corp. And then the final return, I didn't bring up a sample of this, but that would be that 1120 for the C corp. Most businesses don't go that route. You're going to get into what's known as double taxation with regards to the C corp. Now, I will say this: that is a traditional rule that most businesses don't go that C corp route. In the last 5 years, due to federal tax guidelines, C corps are only taxed at 20%. And so there may be an advantage there, but essentially, as a C corp, your tax that tax return, that 1120, does have a tax liability associated with it. So you're taxed on the money from the 1120, and then any money that you receive from that 1120, you are taxed on it again on your personal return on the 1040. So you pay tax on it twice. So for that reason, most people don't go the 1120 route into the C corp route until they're incredibly successful, and then it makes sense from a financial position. We see most people start off as either that sole proprietor or that partnership, and then for whatever, in order to have some of those tax savings that we talked about, we'll then switch over to that 1120S or S corp model in order to take advantage of some of those tax savings. But essentially, those are our main tax returns. Keep in mind your 1040 with your Schedule F for that farming return. That's going to be due April 15th. If you need to receive an extension, you must file that extension by that due date, and you'll get a 6-month extension for both of those. So it'll take it from April 15th to October 15th. If you are a partnership or if you are an S corp, that return is due March 15th. So today is the 12th. We have until Saturday to get those extensions out. Once again, you'll have a 6-month extension. So that's going to take you to September 15th. And then finally, the 1120, if you are the 1120, that's also due April 15th with your 6-month extension. That will take it out to October 15th. So those are the major dates that you do need to keep in mind with regards to tax preparation.
Hey, Dale, I'm going to jump in. We've got about 5 minutes left. Didn't want to cut you off in any way. So if there's something you want to wrap up, otherwise we can ask some questions and close out the day.
I was just getting ready to ask if anyone had any questions.
There's one question in the chat. It said, would that March deadline apply if you have a sole ownership LLC?
No, it is April 15th because you're reporting on your 1040, and that Schedule F is a part of your 1040. So once again, because you are a sole ownership, sole proprietor, your business return is a part of your personal return. They are one and the same.
One of the things we talked about too, and this was Jen's question, I think, was as people are just going through life, working through the farm, what receipts and things should folks keep?
Well, I think that, so receipts are important. I don't need receipts to prepare taxes. What I need truly is that profit and loss statement. When you give an accountant those receipts, they're just going to make a profit and loss statement out of it. You want to keep the receipts in the event that for some reason you are audited and you have to provide supporting documentation for what you've done. And a lot of times I talk about that with clients if we're going to have an extraordinarily large expense that I don't typically see. And like I said, as long as it's correct, we'll report it, but we need to understand. So just real quick, I had a guy before he was a client of mine. He had a business that didn't require a lot of driving. He wrote off a ton of mileage that was not correct to the tune of, I don't know, $60,000 or $70,000. As a result, he was audited for the next 3 years. And that's why they brought me on board to help them through that. Now, does that mean that you can't write off mileage that much? No, because essentially what they did was they contacted us and they said, hey, we saw these expenses. We're going to disallow them. If you agree, you don't need to respond to this letter. If you do not agree, you have 30 days to respond with your supporting documentation as to why you think you were correct. So in this case, let's say once again, for that guy that wrote up a bunch of mileage, I would have told him, keep a mileage log. Let's, keep track of where we're going. And maybe he could have had some sort of log that substantiated that amount of mileage. We would have then sent that in as proof and been allowed to keep that deduction. So in that case, yes, that's why you need receipts or some sort of supporting documentation. But I cannot stress enough, if you want to, get the best result from your taxes, you definitely want to have an accounting system with a that provides you with a profit and loss statement that allows you to prepare your returns.
Thank you, Dale.
Thanks, Dale.
It looks like that's all the questions we have. I think we can go to the next steps, Jamie.
All right. Thank you. Thank you so much, Dale. And we talked about having Dale come on to help folks think about what tax documentation is needed and what paperwork to save and put together as people want to prepare for any financing too. All these go together. Jen, do you want me to just do this slide? Oh, okay. So today's meeting's being recorded. So you'll be able to find that on our website, and we will send an email out in the upcoming weeks with the recording and some resources that we've been sharing today. We have additional information sessions coming up on June 11th and September 10th. If you have any topics that you're dying to hear from, we can help put together speakers for those sessions coming up too. Stay in touch with us to find out about the Business Builder program and application announcements. And if you want to prepare for grant writing, please go to our What You Need to Know webinar series that I linked in the chat and will also be available on our website and resource document, along with the recorded session from December's Tribal Food Producer Information session. And I put in the chat too a link for a quick survey. If you could just tell us how we did or take a picture of the QR code, pull it up and answer the few questions for us, we would appreciate it.
Thanks, Jamie, and thanks to all our co-hosts. Again, please do the surveys. We're trying to make these as the best use of your time as we can make them and our time. So we're very interested in finding out what it is that you all want to learn about. So we can dig up a lot of different experts. So just let us know. If nobody has anything else, I think we'll call it a day.
Thank you.
All right.
Thank you,
Thanks so
Dale.
much, Dale.
Thank
Take
you so
care,
much,
everyone.
Dale. Appreciate it, especially jumping in during tax season. Thank you.
No problem. Take care.
Thanks everybody for being here, and to the team who's helping to lead these. Have a good afternoon.
Bye.